I'm going to do something today that I've never really done on this channel before. I'm just going to go ahead and say it. I don't think we're going to have another stock market crash. At least not in the near term. Now the key word here is crash. Will we have a short-term correction? Maybe even probably. But will we retest the March lows? I personally don't think so. In this video, I plan to explain why I think despite the stock market's recent meteoric rise, I am still bullish on the market, but there are also a couple things that could put an end to this party early, and we'll cover those too. Got a new microphone. Let's do it. What's going on, everybody? Welcome back to my channel. My name is Matthew, and today we are talking all things stock market crash. Will it happen? Won't it happen? Will they or won't they? Give me the format. Now, before we get into the format of this video, let me make two things very clear. First, I am personally bullish on the stock market for the next maybe year or so, unless one of two, maybe three things happen, and we'll talk about in this video. And the second thing, guys, this is extremely important, and I know I say this in every video, but this is strictly for entertainment purposes only. If you follow me and just do whatever I do, not only is it risky because one, I might be very wrong, but two, if I am wrong, you won't know why you did what you did, and that makes it even more dangerous. So guys, please, entertainment only. Let's make this fun. All right, now give me the format. First, the disconnect between the market and the economy. Second, cash is trash ? What this means for stocks. Third, what the Fed is really doing behind the scenes and what you need to understand and also do more research on by yourself. And finally, fourth, the risky risks involved. What could derail this bullish run? I see two, maybe three things in my opinion. Let's start with part one, why the market does not have to reflect the economy. Let me be perfectly clear. I think our economy is in very bad shape. Things are not looking good, yet I'm still bullish on the stock market for the next year or so. Why is that? Because the stock market has no obligation to reflect the actual state of our economy. Is just a common misconception. In 2015, there were about 600,000 US companies who had at least 20 employees, and only about 3,600 of those, or less than 1%, were publicly listed on the stock exchange. Think about that for a second. Of 600,000 US companies with over 20 employees, less than 1% were represented in the stock market. And that's just the beginning of where this disconnect begins. Let's dive deeper into this article where it continues to say that the S&P 500 index is weighted to reflect the performance of the largest, most profitable companies. They're talking about FANG stocks: Facebook, Apple, Amazon, Netflix, Google. Guys, Microsoft, Amazon, and Apple are each worth more than $1 trillion, and they now account for 1/5 of the market value of the S&P 500 index. 1/5. So in other words, this index that everyone refers to as reflecting the market, the S&P 500 index, 20% of it is influenced by just Microsoft, Apple, and Amazon, not to mention Google, Facebook, and Netflix. And the cherry on top is that these huge companies that influence this index are uniquely positioned to benefit from a global lockdown. There is no better situation for these companies than to have you and me stuck at home, glued to our phones, consuming social media, watching movies, TV shows, and signing away more data about our internet behavior every day. So as these companies prosper, it doesn't matter if the other sectors represented in the S&P 500 are only beginning to recover. These tech giants are on a tear, and they're having a disproportionate reflection and effect on the S&P 500 index. And if you're still not convinced, just look at another index, the NASDAQ. The NASDAQ is a tech-heavy index that has thrived because despite the poor economy, tech companies are still able to put up some very strong numbers. Now, there are certainly and obviously other silent, more behind the scenes forces pushing the market upwards, but this is on the surface level while the market looks like it's rising heavily while the economy is struggling and lagging behind. So guys, just remember, the market does not have to reflect the economy. The market is not the economy. The market is not blah, 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 okay? Got it. So let's talk more about those invisible forces in part two, cash is trash and beware of inflation. Guys, just take a look at this photo. What do you see is the problem here? Notice how it says best high yield online savings accounts? Since when is 1%, 1.11%, 1.2% high yielding? Well, since we were launched into an economic crisis and the Fed had to slash interest rates to zero. They also bought a bunch of bonds. And some of you may be wondering, what does this mean? And I highly encourage you to look into this on your own. But for the purposes of this video, this interest rate stuff and this bond stuff just means that your savings account will have terrible yields And bond yields will go down as well, and bonds are usually a safe haven for investors for safe, decent returns. In other words, the places where you would usually go to park your money in times of uncertainty are no longer able to keep up with inflation. And on top of that, it looks like inflation is only going to get worse from here on out. This means the longer you have your money in places like a savings account or in bonds, the more value it will lose over time. And inflation, of course, has to do with the printers going brrr, but we'll talk about that later. And you're going to want to stick around because inflation is very important in today's world, and I just really want to keep using this mic because it's on arm and it looks so professional. I mean, come on. So to prevent their cash from losing value, investors like you and me, and also the big guys, international investors, big firms, they are moving to assets. In other words, the stock market. Why? Well, I personally believe it's because big firms and investors perceive the US stock market in its current state as safe, or at least more risk-free. And it yields much more than 1% a year, and it's a great place to put your money so it doesn't lose value. And as the big guys put their money into the stock market, stocks go up, giving them more reason for the big guys to put their money into the stock market. And as they put their money into the stock market, stocks go up, giving them more reason. It's a feedback loop.
Wait, rewind. Did you just say that stocks are safe? Aren't stocks usually perceived as very risky assets?
Well, usually, yes, they are. They're considered very risky relative to everything in the finance world, especially compared to, say, something like a government bond. But guess what? As we said before, those government bonds aren't yielding anything anymore, so it's kind of the last place to go. And here's where my theory develops. Well, it's not really my theory. It's a theory commonly held among bulls, but here's where it develops. Certain stocks may be perceived as less risky, and we'll talk about those in a second, but the stock market in general is also perceived as less risky because of something that the Fed did that we'll also talk about right after we talk about the first thing. Okay, so two reasons. The first reason goes back to the FANG stocks. These FANG stocks, except for maybe the exception of Netflix, are pretty much unkillable. The last 6 months have proven so. In my opinion, FANG stocks are one of the safest, highest yielding investments you can make right now. Let me ask you this. Do you think that Apple, who has over $190 billion in cash, has proven survivability through a global shutdown and has one of the most sticky, powerful customer ecosystems ever made, is going to go under? Do you think that Facebook, who has over $60 billion in cash, has come out of this lockdown stronger, leaner, and more cost efficient, has over 2.5 billion users on its several platforms every month, and who dominates the advertising market, will go under? The list goes on for these FANG stocks, but I hope I got my point across and you kind of understand why I think these are considered safe investments when you can't go anywhere else with your cash. And I'm not just talking about you parking your cash somewhere, I'm talking about big international investors, big US firms. This FANG stock is a global beacon of safety because they're not going away. And again, this is just my theory, so please don't just go buy Apple and Facebook tomorrow because of this video. Seriously, please. But I said there were two main reasons why people are going to the stock market and perceiving it as more safe. The second reason, perhaps more indirect, is the Fed. Let's talk about this second reason in part 3, what the Fed is really doing. So I want to preface this section with a quick shout out to the Fed Observer here on YouTube. He's one of the only channels that I've found who is tackling these more complex ideas and explaining it for everyone. Him, along with many hours and 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 hours of reading articles, led me to create this video. All right, guys, so we've all made jokes, or at least I have, about how the Fed goes brrr and how they have our back on every dip because Jay Pow Pow just prints more fat stacks of money. But let's get serious. Because if your actual reason for buying the dips and your actual knowledge on what the Fed is doing only extends as far as, I don't know, Fed goes brr, then you're putting yourself at significant risk. Because as Papa Buffett says, risk comes from not knowing what you're doing. Quick disclaimer, I have done a lot of research on the Fed's involvement in today's market, but it's a kind of complex topic, so if you're an expert in the field and you see anywhere where I may have had a misinterpretation, please let me know in the comments down below immediately so we can get that rectified and put out a better new video. But if all is good, let's get on with this one. The Fed is arguably the biggest factor in the stock market today. In fact, I would argue that it is. They have essentially killed the free market and are allowing zombie companies to survive and destroying capitalism, but that's a rant for another day. Now, for any beginner investors out there watching this may sound a little confusing with this new jargon, but promise me you'll try and watch this through because I think there is some important information here. To combat this crisis, the Fed acted swiftly and created several special purpose vehicles. And a special purpose vehicle is, just imagine like a way for the Fed to move money around, sometimes in places where they're not supposed to put money. The two special purpose vehicles that are arguably the most important in regards to the stock market are the primary market corporate credit facility and the secondary market corporate credit facility. Wow, that is a mouthful. These two vehicles allow the Fed to buy corporate debt. Remember that. Buy corporate debt. This is technically illegal and it is terrible for capitalism, but for now, it's good for the stock market. Let me explain. Corporate bonds are bonds issued by companies to raise financing. So what does that mean in a simple example? Well, say I am a company and I need money for a project, but I don't have enough cash. So I can issue a bond. An investor can walk along and say, I'm going to buy this bond from you. They give me the money, they get the bond, and I get to take this money, but because of the bond, I have to pay interest on the money they just gave me. So it's like a loan. It's like me borrowing money or taking on debt to finance this project. Hopefully this makes sense. So at the end of the project, at the end of the bond, everything, I have to pay interest, and then at the end, everything should be resolved. Guys, I know this content is really dry, but please stay with me. I think this is really valuable information. So when stocks first started crashing, a lot of it had to do with one, it looked like a lot of companies were going to go bankrupt, and two, it did not look like they were going to be able to get credit or issue corporate bonds to stay alive. Because think about it this way. If I'm an investor and I think that a restaurant's going to go bankrupt, but they're trying to sell me a corporate bond, why would I be interested in buying their corporate bond? Now, say I'm the restaurant, okay? We're burning through cash trying to stay alive. It doesn't look like we're going to make it through this whole global situation, but we need a loan. We need money. We need to take on some debt to survive. But we can't sell our debt to anyone because we're going to go bankrupt. So no one wants to buy debt from a company that's going to go bankrupt, because that means as an investor, whoever you're giving money to, they won't be able to pay you back if their company doesn't exist anymore. Does this make sense? Hopefully it makes sense. So the way I interpret it, this was the problem, because no one's going to buy corporate bonds from a company that's going to go bankrupt, because if they go bankrupt, they can't pay you back. But if no one buys their corporate bonds, then they have no way of surviving through this situation. But on March 23rd, the Fed stepped in and said, we will buy corporate bonds. Look, here it is, March 23rd. They said, we will buy corporate bonds. And guess what else happened on March 23rd? The market bottomed. The market has not looked back since. So by saying the Fed was going to buy corporate bonds, something that was technically illegal and had never been done before, the Fed, in my interpretation, basically told other investors, you guys can come back now and buy corporate bonds from these companies, because if you don't, we will, and they'll be able to last through this whole global situation. Because now that they can sell their corporate bonds again, they have easy access to money, to borrowed money. Had the Fed not stepped in, we probably would have seen a lot more companies go under and a lot more people lose their jobs permanently. So now the Fed is kind of acting as like a backstop. So if anything goes south again, the Fed will be there to buy corporate bonds, allowing these companies to borrow money very easily and try and outlast this thing. So in summary, I'll try and condense this by walking in and saying we will buy corporate bonds, not from every company out there, but from a lot of companies. This gave confidence to a lot of other investors who actually front run the Fed, because they're like, oh, the Fed's coming in, this is safe now we can start buying corporate bonds. So the Fed actually allocated $750 billion to the primary and secondary market corporate credit facilities total, meaning that's how much they can spend on buying corporate bonds. And they've only had to spend about $10 billion, because again, the other investors said, Fed's coming in, it's safe, let's roll, boys. And the Fed hasn't really had to do too much in this area. Now, this is good for the stock market, but before you go out there and just buy everything, please don't do that. There are still some major risks. Part 4, the risks involved here and what could potentially derail this bullish market. There are two main things and another potential worry that I want to talk about in this section. First, inflation. Second, the election. And third, government stimulus and unemployment benefits. All right, so first is inflation, and this is probably one of my biggest concerns here. And again, special shout out to the Fed Observer. The Federal Open Market Committee had a meeting on June 9th to 10th, and one of the things they talk about was possibly tying their forward guidance to inflation. In other words, could inflation metrics influence our plans and actions moving forward as the Federal Reserve? It was noted that some participants suggested that forward guidance be tied to inflation outcomes, which would then suggest that if inflation rises above their goal of 2%, then the Fed might take their foot off the gas a little bit, and that is no bueno for the stock market. Now, I want to emphasize this was just a suggestion. No decision was made. There were other suggestions like tying forward guidance to unemployment numbers. But another thing I should note is that we're actually in a disinflationary period right now, meaning inflation is not rising. With everyone at home locked up, no one's out there spending and spurring that cycle of hyperinflation. And as of July 13th, this article said that an inflation reading on Friday, meaning July 10th, indicated that the extraordinary actions of the Fed are not going to raise inflation flags anytime soon. So we've still got time before inflation really becomes a factor, especially in terms of the Fed's forward guidance. But in my opinion, I think in order to inflation to really become a problem, things have to go back to normal. If inflation does spike, I will have to rethink my bullish thesis. The second concern is the election, and I don't want to get political on this channel, so I'll make this quick. What I'm about to say has no semblance of my political views. It is strictly in the lens of looking at the stock market objectively. Generally speaking, Democratic presidents are not great for the stock market because they'll put more restrictions on corporations, and Biden specifically would likely tax corporations much harder than they're being taxed right now. Part of the bull market before was because Trump made major tax cuts on corporations, meaning they could save a lot more money that would go directly to their bottom line instead of to the tax man. So if polls indicate a Democratic president, that could be a little concerning for the stock market and things could get a bit iffy. The final concern, and something I haven't really fully made my mind up on yet, is government stimulus and unemployment benefits. Benefits are scheduled to run out soon. If Congress cannot come up with an extension plan for the $600 a week unemployment benefits, then on July 31st, the program will end, and this could awaken and reveal some ugly underlying problems. But of course, there are a lot of things going on here, which is why I'm still not really sure how to look at it. On one hand, you have people saying that 4 out of 10 jobs from before Rona are gone forever. On the other hand, you have people who are making more from unemployment than they were at their actual jobs. On another hand, I don't know how many hands you have, probably 2. But on the other hand, you have people who aren't spending their unemployment benefits wisely, and they're kind of just, gone. And then on your fourth hand, somehow, you have people who are not even looking for jobs because their unemployment pays so well. So we really don't know what a good picture looks like of when people are actually looking for jobs. This is a lot to unpack, but it's certainly something to keep your eye on. So that is why I'm bullish on the market in the near term, but hold on guys, I've done a lot of research on this topic, but I am still learning, and I'm very confident in my presentation and the facts I've presented today. But if you're an expert in this field and you see anything that was misinterpreted, or if there are any holes in my argument, please let me know ASAP in the comments down below so we can get that fixed right away, and we'll come out with a new video right away explaining where we may have gone astray. But if all that's good, I think the market is going to be bullish for the next year or so, unless there are a few things like inflation or an election or unintended or unforeseen consequences with unemployment benefits. So make your own opinions, don't be ignorant, be willing to change your point of view, and hopefully we can all do well together in these crazy times. Let me have it, bears. Let me hear all your arguments in the comments down below so we can get some intellectual conversations going, but just try and be respectful. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and check out our quote of the day. You might just learn something. It's a little long one, but I think it's valuable, from the man Peter Lynch himself. Make sure you go follow me on Instagram for daily posts about my portfolio, my views on the stock market, and stocks I'm watching, and all that good stuff. Thank you so much for watching at this point in the video. You are the real MVPs. Don't forget your peace, and thank yous.